This is the CRE Weekly Digest by Lightbox, a data and technology firm for the commercial real estate markets. I'm Martha Kocher, and I am thrilled to be joined by my colleagues, Manus Clancy, Head of Data Strategy, and Diane Crocker, Research Director. For the week of June 24th to the 28th, some macro news. Banks passed stress tests, inflation remained unchanged in May, and the parsing of last night's presidential debate is in full force on the news cycle. But Manus, you wrote in our latest market commentary that the CRE game in June ended with a push to no satisfaction of the Bulls or the Bears, and we're not talking about sports teams. You're going to give us the big picture, but before we do that, I just want to say it's great to be back in the pod seat.
Oh, I have to agree, Martha. It's great to be here. For those that are listening to the first time, Martha and I have done, I guess, about 150 podcasts in the past. We love doing them. We love our audience. We love talking about all things commercial real estate. We know that the bar is very high. There's a lot of good commercial real estate podcasts out there. So we're really grateful for people joining us today, listening to our thoughts. Hopefully we'll keep it light, interesting, and fun. Fun is always something we hope to do with this and not make what can be a dry subject matter even drier. So it's great to be back in the saddle, and it's great to have Diane with us. She will keep us honest and on point and to what I think is an interesting conversation.
Thank you so much, Manus. Happy to be here. Thanks, Martha, and happy last business day of the second quarter.
So Manus, let's get right into it. You want to give us a big picture review. And as we're heading into the second half of the year, what do you want to give us to digest here?
Well, before I get into some of the economic data, I will address the point that you brought up in the beginning that June was a push. And I think that's about right, that June 2024 represents the 2-year anniversary of the CRE slowdown. People will remember, probably with a great deal of pain, that CPI hit 9% in June of 2022. That forced the Fed into really aggressive rate hiking, which did a lot to this market. It slowed down the pace of refinancings. It made it so that CRE property owners couldn't refinance. Their numbers didn't pencil out without cash in to refinance. It led to an uptick in defaults. Values of both loans and properties fell as cap rates surged. And people that make their money by originating loans, by brokering properties, by leasing, and property owners who make their money by operating portfolios of properties have endured a really difficult 2 years. And while we've seen some green shoots in the market, and Diane will talk about that over the course of the next 40 minutes or so, those green shoots have been popping up painfully slowly. And we're hoping that the second half of 2024 shows a more robust recovery than what we've seen thus far. That being said, we have seen things pick up, and there are some signs of life out there. I'm going to touch upon that during today's podcast. For those that have listened to me in the past, I'm one that tends to see the glass half full, and that will come out today. And it's Diane's job to keep me honest and not allow me to be too exuberant or too enthusiastic or too Pollyanna. So before I get into some economic data, let you react to that, Diane. It's a heavy lift if you've ever listened to my podcast before, reeling me in.
I'm up to the challenge, Manus. You know, the state of the market right now, I feel like, is a pretty even mix of headwinds and tailwinds. So it's definitely a battle between the Bulls and the Bears. And you have to kind of watch all the metrics and decide which side of the fence you want to stand on. But I mean, I agree with you that there certainly are some encouraging signs coming out in the market of late. And as you said, as we prepared for this, if folks are only watching the headlines, then they run the risk of missing some opportunities, because I think the things that we'll cover here today really show that opportunities are starting to surface, and that, to use the word from your June commentary, the intrepid investors who are willing to jump in early are going to be the ones that benefit. And I think and hope that we're in the early stages of starting to see the market thaw a bit, despite the fact that the Fed kind of has the market at its heels by keeping rates higher for longer.
I think you hit it spot on. I think that when you look at the people that dove in 1992 or dove in 2010, when we were coming out of really difficult times, the returns were extraordinary for some of those. I remember that David Tepper and Appaloosa Capital were big buyers of commercial real estate debt when it was trading at 20 and 30 cents on the dollar. And a lot of that came back and traded at par within a couple of years. And that was just an epic trade for them and just incredibly profitable. I don't know if anybody's going to make 5 times their money in this cycle now, but I do think that there's really good opportunity now that we're seeing more transparency in office sales, things trading at 70 or 75 or 80% off of 2015 prices. And we will go through that. But without further ado, let me get into some of the data that we saw this month. Even though the month was a grind, and by grind, I mean that activity was up, but only modestly. The recovery that we're hoping for is still quite in its early stages, very slow. But we did see 3 or 4 pieces of data that were very promising. First of all, we got a CPI number that was benign, slightly below expectations. That triggered a nice reduction in long interest rates when that came out. That was followed up a couple of days later with a surprisingly cool PPI number that sent bond yields tumbling even further. As we all know, lower bond yields mean lower cap rates, lower cost of funding, which turns into higher property values, and it allows more refinancings and new sales to pencil where maybe they didn't. The reaction month over month was good, but not great. The 10-year yield dropped about 20 basis points over the course of the last 30 days, which is very nice, right? 20 basis points is 20 basis points. And then this morning on June 28th, we saw a pretty good PCE number. PCE, Personal Consumption Expenditures Index, is said to be the Fed's primary driver of inflation. It came in flat, which met expectations, and the market was relieved that that was not a disappointing print. So all in, pretty good month, slightly higher activity, falling interest rates, some good inflation data, and hopefully that sets the tone for future growth in July, August, and September.
Thanks, Manus. I agree. There are a lot of recent developments, and one of the things that we're starting to do here at Lightbox is track on a monthly basis the overall CRE activity. So our new activity index is an aggregation of daily transactions across our network and measures the changes in the velocity of property listings, of valuations, and environmental due diligence. The index is a number which is benchmarked against a Q1 2021 baseline, and it's essentially a way to visualize in a data-focused way some of the things that Manus, you just covered, and some of the things that we're seeing in recent headlines. So in our latest May index, which came in at 91.1, what was interesting to me was that was a continuation of a 3-month uptick in velocity that started in March after February's decline. So they were modest upticks. It was 91.1 in May, up from 89.5 in April. But, still, despite what we talked about, that the Fed is digging in its heels and keeping rates higher for longer, we're starting to see steady increases, and especially after December's 3-year low, which was at 45.7. So those readings of late, I think, are evidence of the kind of news that we're going to be highlighting in these podcasts, Manus, and shows that the wheels are starting to move in a way that they really weren't in November and December when the index readings were much lower. So when we think about what's happened so far this year in the market, we went from, expecting 6 interest rate cuts this year to now expecting 1 and maybe none. I was in London last week, and the headline was, with inflation still high, rate cuts are off the table. And I thought, well, doesn't that sound familiar? And here we are on this side of the Atlantic with all eyes on July's inflation data. So by next week, since the quarter closes at close of business today, we'll have that June number. And I'm really interested to see how the June index compares to May's number, which was 91.1.
Knows that I often take deep detours on things. So I'll take a detour now. For those that don't know, the Lightbox Index is made up of really 3 components. We procure appraisals for hundreds of U.S. banks every month. So we have a sense of how many appraisals are being procured in any given month. We do the same for due diligence on the environmental side. We see how many phase 1 and PCAs are being ordered every single month. And then RCM is a product within the Lightbox suite that is a listing service for properties big and small across the US, and it handles about 50% of all CRE sales every month. So there's a lot of economic data in there, and I think it's a leading indicator of where the CRE market is going.
I'll jump in too, Manis. I think the elephant in the room, which Martha, I think you mentioned in your intro with last night's presidential debate in the rearview mirror. I think the elephant in the room is we're heading into a divisive political election season. And I think in any normal election year, we'd probably see a little tap of the brakes in late Q3, early Q4. But I think this is anything but a typical year. So it'll be interesting to see how the Lightbox CRE activity index kind of plays out as the second half of this year unfolds.
Yes, I was the big winner last night. I chose not to watch. My wife and I sat outside, we had a cocktail, and we did everything we could to avoid it. So we were the big winners last night, it sounds like.
It was a win. Man, it's one of the things I know we want to cover regularly are 3 things that caught your eye that's happened over the course of the week.
Yes, I'll run through these very quickly. They're meant to be indications, maybe contrarian indicators of the narrative that is out there in the press. Some of the narratives we see on social media or in the national media, CRE is dead, huge losses are coming, bank failures are going to be plentiful. And the truth is that because I'm a glass half full guy, I don't think a lot of that is true. I don't think we're going to see dozens of bank failures. I don't think CRE activity is going to dry up like it did in 2009. So the big 3 every week will be something that runs counter to the narrative that we're seeing. I'll start off with the first. This is from Commercial Observer, very positive story in Florida. JP Morgan is going to double its Miami square footage in its office. It'll also open a new office in West Palm Beach. JPM currently has about 80,000 square feet at 1450 Brickell. They're going to double that to 160,000 square feet. So I love telling these types of stories because rarely do you see a story these days about somebody doubling their footprint and adding a new office. Usually it's law firms and accounting firms shrinking their square footage. And in this case, JP Morgan going against the grain, which we love. Another one here, this is from The Real Deal. KKR will spend $2.1 billion on 18 apartment complexes. They are acquiring those assets from Lennar. The assets are mid to high rise. I would call them semi-luxury or luxury buildings, probably. The whole portfolio covers 5,200 units spanning the West Coast to the East Coast. What caught my eye here is that a lot of the properties are in Texas, Florida, Georgia, North Carolina. And there is this narrative out there that, the Sun Belt was overbuilt. Valuations were overinflated in 2022. There has to be a resetting of the market. And yet here you have KKR, smart guys, people that look for double-digit returns, jumping into these markets. So if KKR is seeing opportunity in these markets, there's probably opportunities for buyers that are smaller in size that are willing to cut their teeth going through the numbers and seeing what's out there. So that's item number 2. Item number 3, this comes from Pincus and others. People reported this as well. One Liberty Plaza in Lower Manhattan is a 2.3 million square foot office tower. There is $750 million in debt on that property. The narrative out there is that office is dead, losses are going to pile up. What happened with this particular asset is even though the value has fallen from 1.5 billion for that office to about 1 billion, the borrower was able to land a 5-year extension on this particular loan. And that's one of these stories where I would say not every office, even in markets that are unloved, in locations that are not unloved, that are unloved, is necessarily going to go into the deep discount bin, default, and resolve with a loss. So
the JP Morgan office story, I think, is an important one, especially this week, because I don't know if you saw the Bloomberg article, which cited that nearly 1/4 of all office space will be vacant by 2026. So that came out this week at the same time as this story. And I think, in fact, all 3 that you mentioned, these are important bellwethers coming out, out of a market thaw that really send a message to the rest of the market that deals are happening if the numbers, work out. So as we said before, the headlines aren't really telling the full story. Here's a major occupant who's actually doubling their office space. So it's another example that disproves the narrative. And it reminded me of a speaker that we had at Prism. You might remember Jeff Garvin, the chief appraiser at Bank OZK, and he noted this flight to quality trend in office that obviously Class B and low grade A are going to face challenges, but high quality office projects like these, whether it's in South Florida, like the example you gave, or strong markets like Dallas are seeing interest, are seeing an uptick in office leasing. Yeah, and what came to mind when you were talking about the KKR story was our scorekeeper model tracks trends in environmental due diligence. So before any big transaction, or in this case, a multifamily portfolio, scorekeeper is going to track what metros are seeing higher activity than others. And it's a lot of the areas that you cited in this portfolio, metros like Atlanta, like Dallas, like Miami, others in the Sun Belt that are seeing activity performing above those US benchmarks. So I wasn't surprised to see those areas of the US included in the portfolio, because I think those are among the hot spots that investors are definitely keeping in their crosshairs.
Very, very good point with that first story. And people will probably criticize me as I cherry pick that one JP Morgan story when there's 99 other negative stories. And there's a little bit of validity to that. My point being that not every single story in the office space is negative. But your point is spot on, that we're seeing a bifurcation right now in the office market where people with Class A plus new inventory with tremendous amount of amenities have had a much better chance of holding up in this market. I don't know 1450 Brickell per se. I've never been in that building, but I imagine that it's a really, really nice high-end building. And those owners have been weathering and will probably continue to weather this downturn better than the Bs and the Cs, to your point.
We are going to start walking through some specifics on who's buying, who's selling, who's lending. So Manis, why don't you get us started on who's buying?
Yes, we'll run through these kind of quickly. We picked something from a bunch of different segments of the market. We'll try to give you a few of each. In Orange County, California, MGR Real Estate acquired 2020 Main and Irvine for almost $54 million. There's good news and bad news in this story. The $54 million is said to be the highest price for an Orange County office property this year. And sadly to say, anytime you see something sell for north of $50 million these days, it's a sign of relief. The seller here was PGIM. The sad part about this story, it's a 23% discount to the 2001 sales price. Here, the property was 44% occupied, so MGR certainly looking for an opportunity to either reposition or re-tenant that building. There's another one here. This is in the Las Vegas market. I really love this one. NNC Apartment Ventures acquired Millennium East in Las Vegas for $53 million. This is a 236 unit property. Why did this catch my attention? You don't hear this type of information too much these days. That property sold only 2 years ago for just $26 million. So for Aspen Square Management, 100% profit before taking into account expenses and capital costs. Not bad. In that particular case, Northmark's Thomas Olivetti marketed that deal through what we were talking about before, the RCM platform. So good on Northmark for getting a premium price, and good on Aspen Square for a big profit on that particular deal.
That was my favorite one on the list, just because of what you said, the profit margin of 100%. You're not seeing that much today. And I think it's yet more evidence that the generalizations out there are just that. It's evidence that if the market's strong, if there's high population migration, strong job growth in a particular metro, defensible rent expectations, then deals can pencil out, and sellers who have capital that they're impatient to deploy, or buyers rather, that they're impatient to deploy, are thinking that now might be the right time to think about buying and thinking about jumping in. I think that whole FOMO mentality at a period of market recovery that we're in right now is really top of mind for a lot of folks with capital.
I think you're absolutely right. I thought this one was really interesting. The buyer here, Hamilton Zands. The story comes from Ashley Gerbal Kritzer of the Tampa Bay Business Journal. They paid $51 million for a 192 unit property in the Tampa Bay area. The property is called Jade at North Hyde Park. The sale represents about $265,000 per unit. Why did this one catch my eye? It caught my eye because I think of the Tampa market, especially on the high end side, to be pretty strong, to be pretty buoyant. But in this particular article, they pointed out that the Gray at North Hyde Park, which is kind of a sister building less than half a mile away, sold for $410,000 per unit not too long ago. So Hamilton Zands picks up this asset for a 35% discount to a similar property that sold recently. Here, the seller was Wingspan Development, with Berkadia financing the loan for the purchase.
Let's move on to who's selling. And before you come at us with some very ebullient news stories, how do you react, Manis, to that not so ebullient story in the New York Times earlier this week about landlords looking to offload their struggling properties and banks quietly looking to put out feelers to see what they can get regarding the values of some of those properties to take some of the risk off their portfolios.
There's a lot of headline risk for banks. The bigger their commercial real estate portfolios, the more they're in the crosshairs of the media and their boards and their investors as to how they're managing this problem. One way to make that problem become less evident is to sell loans. In many cases, these loans are probably getting sold at discounts, prices of 95 cents or 90 cents on the dollar, but it allows them to tell the narrative that they are not as exposed to office or commercial real estate in general. So it doesn't really surprise me at all. And we've seen some big ones. We saw Bank of America pick up a $3 billion portfolio from a West Coast bank in the last couple of weeks. I think the silver lining of this story is that these banks that are selling loans are finding buyers. The market is not locked up. It's not seized up. It's not one of these things that the banks have to sell them at pennies on the dollar to the buyer of last resort. And that's why I don't think we're going to see dozens of bank failures. I think that the markets are liquid. People are going to be able to sell assets. They'll take losses, but the losses will not be catastrophic.
You know, Manis, it's a good point. I think of the good and bad things that you mentioned at the start of the podcast, the one that I've really been thinking about this week is the news that 31 of the largest banks in the US withstood stress testing. You know, and that's under a hypothetical, I think 40% drop in valuations. So when I think about that news this week, which is obviously a positive, it was only 3 weeks ago that Moody's came out and said, look, we're going to downgrade 6 regional banks because of their commercial real estate exposure. So, you know, I don't think it's trivial to say that the biggest banks have passed the stress test. To the point you made earlier, Manis, you know, we don't want to be too Pollyanna here. It doesn't mean that banks are out of the woods. And I think a lot depends on when Powell does decide to move rates down. But this was one, I think, of the more reassuring headlines that we saw of late.
Yeah, banks are certainly much more well capitalized than they were 15 years ago in 2008. That's undeniable. And I do think, while maybe we had some froth over the last 3 or 4 years, I think even in 2021 and 2022, banks were still feeling the scars of the great financial crisis. And I don't think that they completely lost discipline during that time period. I think that some discipline may have been lost with floating rate debt in the CRE CLO market, but I don't think it really was as dramatic on the bank side. Maybe I'll prove to be wrong. Maybe history will show otherwise, but that's my gut feeling on this. There'll be problems, but they will not be catastrophic.
Yeah, and I agree. And I think that's one of the important things that you covered at Prism when you outlined why this downturn is different from ones previous. It's because of that discipline, and obviously attention from regulators is also very, very compelling in terms of how banks behave at times like this.
No doubt.
One of the things that we're tracking and reporting on now through the RCM platform is the average number of non-disclosure agreements per RCM listing. So that's really a measure of how many folks are coming to the table as potential buyers and taking a closer look at listings that are on the selling block. The average in Q1 was 99 per listing, and it was even higher in multifamily and retail, not surprisingly. So I think it'll be really interesting when we run our Q2 numbers next week to see if that average number of NDAs increases or decreases, because that's really, it's going to be a barometer of the pace at which the buyer pool is increasing or decreasing as investors start to dip their toes back into the water and make the kind of headlines that we're highlighting here on the podcast.
Great point. And it's something I don't want to dig too much into today, but I think it's a wonderful topic for a future podcast, going through these numbers in greater detail, because it does underscore the fact that there's a lot of capital out there and there's a lot of people circling these deals. And we should get into that more in future podcasts.
100%. Or just being curious. If they're not quite ready to deploy yet, they might just take a peek to see what's out there.
Let's cover a little bit of who's selling right now, Manis.
Well, for those that think that maybe they've missed the boat on what is out there as opportunities, I'll throw out 2 things that caught my eye this week, one in Charlotte, one in San Francisco. The Charlotte Business Journal reported that MV2 Investments is looking to sell several development sites and 2 high-end apartment complexes, asking prices about $80 million. And Nick Gonzalez of Linville is offering that portfolio, reporting there by Hugh Ugly of the Charlotte Business Journal. And in San Francisco, the Meyer family has put 3 properties on the market. This totals 154 units. Those properties have been in the Meyer family for 7 decades. Collier's Brad Lagamarcino is handling the listing alongside Dustin Dolby. This story comes from the San Francisco Business Journal's Sarah Clearman.
And let's round out our list with who's developing.
Yeah, I love this segment, and I'm looking forward to doing this every single week because what it shows is a level of intrepidness. If you're willing to borrow 9 figures or 8 figures on something which involves a complex, difficult, lengthy conversion of something, you really have confidence. And when people have confidence, I think that's the best of green shoots. It's a vote of confidence for a property type, a neighborhood, a city. And when I see them, it just makes my heart race. So let me start very quickly. In Cleveland, Spark GHC has acquired the Rose Building. This is a nearly 400,000 square foot property. It had been the headquarters of Medical Mutual. That firm moved elsewhere in Ohio a couple of years ago. Spark plans to redevelop this asset into a hotel. They're going to put $100 million into this, which is not chump change. Obviously, it's a lot of money. It's a lot of risk, and good for them for taking that leap. That reporting comes from cleveland.com. Elsewhere in New York City, Metro Loft and David Werner Real Estate are about to kick off a plan to convert the old Pfizer headquarters in Midtown Manhattan into more than 1,500 apartments. Pfizer was about 2 or 3 blocks away from Grand Central Terminal. It's probably a really prime location for people that work in Midtown Manhattan. But these conversions aren't cheap. They're capital intensive. They involve a lot of execution risk. So kudos to Metro Loft and David Werner for leaning in on that particular development. And in Chicago, this is kind of a middling type of story. Sterling Bay was looking to develop a 28-story apartment complex on Carpenter Street, 370 North Carpenter. They were slated to do that with JP Morgan Asset Management. Now Sterling is listing that development site for sale. So for those that want to become intrepid developers, this is your chance. If you want to take this project over from Sterling, the opportunity is there. The listing is being done by JLL, reporting there by the great Danny Ecker of Crane Chicago, one of my go-to reporters that I follow every single week. There are several of them, Danny among the best. So that's what I have on the new development. More to come next week.
We had a question from one of our webinar watchers from our mid-year webinar. And if you hadn't watched it, it's available on demand at our website, lightboxre.com. The question was, how are buyers underwriting their office acquisitions in a soft submarket and building is 60% occupied?
I think there's 3 ways to do this. It really depends market by market, property by property. Some certainly are basically looking at this as land value, right? I have to take this, I have to strip it down to its shell, which is not easy, right? That could be $75, $100 a square foot to tear something down, or at least pull it down to its frame. Then it's capital intensive. So I think for some people that think it's a really gutting of the building, I think that you're looking at this at land value minus whatever it's going to take to reposition. I think if you're talking about something that is transitional, meaning it's a B that you're going to try to make an A, you're going to try to make it amenity rich. I think that to some extent, that is the ultimate leap of faith, right? That I'm going to take this thing, I'm going to put in a pickleball court, I'm going to put in some sauna rooms, a back rack and stuff like that. And I'm going to try to, if it's in New York City, maybe move it from $60 a square foot to $100 or $120. There, I think that it's completely execution risk, right? If you do it right, you can get $100 a square foot or $120 a square foot, but you are, I don't know, it's a very big leap of faith. For those that are just going to operate this as a B or C, I think you're underwriting it to worst. I think you're saying anybody that is facing a renewal is 50% likely to vacate. I think that you're discounting the rent you're going to get enormously, right? You're probably looking at 1/3 less per square foot than you were getting. You are probably underwriting to enormous tenant improvement costs, lots of free rent. So I think you're underwriting to worst. You're underwriting to, I'm going to lose half my tenants. I'm going to spend a fortune tenanting this up. And that's why you're seeing things sell at 80% off, because that's where they pencil that if I'm going to have to throw in $30 million to rebuild a tenant base, and I'm going to have no rent for a year or two for some of these tenants, I have to get this at an extraordinary discount. And that's what we're seeing right now.
The old hope for the best, plan for the worst mindset.
Buy the worst. That's I think the mantra right now.
So, it's summer in New York, and one of the interesting sites that we've heard people talk about lately is one that's only visible 4 times a year, and that's Manhattanhenge. And of course, it gets its name from the famous Stonehenge, but in this case, the setting sun aligns perfectly with Manhattan's streets between the buildings, and the phenomena will occur again July 12th and 13th. Our team actually mapped the perfect locations to check that out. Manis, Diane, I don't know what your plans are for the summer, but if that's at all of interest, you might want to check that out. It'll be an interesting thing to watch.
I think it's of extraordinary interest to some people, just like eclipses and shooting stars and things like that. No doubt about it. I could picture myself forgetting about this discussion we're having right now, walking down the street on July 12th with the sun staring me at the face block after block after block and thinking, what is going on here? And thinking, I have to walk in a different direction because I'm getting blinded right now by the sun. So that's how short my attention span is. And that's kind of how I picture this playing out in 2 weeks.
I love it. And when the sun sets tonight, I'll start running our Q2 metrics. So we'll have something to report on the next podcast.
Perfect. We'll be recording early next week and sharing our monthly CRE activity index with that. We'll end this inaugural podcast. Thank you to Hannah Tebow, our producer. Please join us each week as our Lightbox team shares CRE news and data in context. And send your questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.